Hi, everyone. I hope you're all having an amazing day today so far. My name's Jake McCloskey. I'm a producer here at Gallagher. I wanted to thank you all for joining us here today. We really appreciate your time. We thought it would be very valuable to have Trusaic come on here to speak in depth about how you can leverage the employee retention credit. So from here, I'd love to introduce you to Joanna Kim, who will be presenting to you all today. So thank you.
Good morning. My name is Joanna Kim. I'm Vice President of Regulatory Affairs at Trusaic. And so today I'm going to be talking to you about the Employee Retention Credit, basically going over what it is, how it got introduced, who's eligible, how much, and how you can maximize it. Okay, next slide. Okay, so the Employee Retention Credit was first enacted through basically a response to the COVID pandemic back in March 27, 2020, and it's been since amended twice to basically expand the Employee Retention Credit. And what is it? It is a refundable credit against employment taxes, and it's calculated based on qualified wages paid to employees between March 13, 2020 to December 31st, 2021. So you're looking at a 21 plus month time period. And as I mentioned, it was first enacted on March 27th, but the sort of oddity of the qualified wages period is that it starts March 13, and basically that was when it was first introduced in the House. So you've got this time period, and the rules, depending on whether it's 2020 or whether it's one of the first 2 quarters of 2021 or the second 2 quarters of 2021, the rules are very different, and so it's going to be important that each, the rules that you look at for 2020 are different for the 2 different halves of 2021. And so we've got the CARES Act, which is the Coronavirus Aid Relief and Economic Securities Act. That's the CARES Act. That's sort of what really sets the stage for 2020 rules. And then what happened was late 2020, there was the Consolidated Appropriations Act, which added in sections 206 and 207 and basically created amendments largely to expand the employee retention credits, essentially to allow more employers to qualify, loosening the employer size threshold, removing the bar from the Paycheck Protection Program eligibility rules, and expanding the time frame. And then earlier this year, under the American Rescue Plan Act, there was further expansion to add in Q3, Q4. Now, the Employer Retention Credit, or the ERC, is available to both profit companies and nonprofit companies. And additionally, it is available to limited government employers. But as I had alluded to a moment ago, the rules are a little different for 2020 and 2021. So if you're a limited government employer, meaning you are either a public college, public university, or a government entity with your principal purpose or function to provide medical or hospital care, those are what we call limited government employers, you're only eligible for ERCs in 2021. They're not available to you for 2020. Okay, next slide. Next slide. I'm sorry, I think we might be having some technical difficulties here. Can we move to the next slide? Colleen, can we move to the next slide, please?
Yeah, I'm moving. I just think I might have some connectivity issues.
Okay, well, I will just talk then. Okay, so one of the first, there we go. One of the first issues that you're looking at when you're looking at the employee retention credit is, well, what's the maximum employee retention credit that's available? That's an important consideration. Again, as I mentioned, the rules are different depending on the time frame. For calendar 2020, the maximum employee retention credit is $5,000 per employee. For 2021, for each of the quarters, the maximum ERC is 7,000. So what that translates to is a maximum of 28,000 per employee. So when you look at it cumulatively, what you're looking at is a maximum employee retention credit of $33,000 per employee. And there's slightly different rules in terms of what are the qualifying wages. If you are, and again, like as I said, there's different rules for different time frames. There's also different rules depending on what your employer size is. So for 2020, if you are an employer with 100 or less full-time employees in 2019, you're eligible for maximum ERCs based on qualified wages paid to each employee for both 2020 and 2021. Now, if you're an employer above 100 full-time employees but less than 500 full-time employees in 2019, the rules depend on the year. So for 2021, you're eligible up to the maximum amount based on qualified wages paid to each employee. However, with respect to 2020 ERCs, eligibility is based on qualified wages paid to each employee who did not perform services. So that's going to make a big difference. And if you're an employer above 500 employees in 2019, for both 2020 and 2021 ERCs, eligibility is based on qualified wages paid for each employee who did not perform services. So typically, for example, what you may have is where employees were paid even though they didn't work, and payment would include, among other things, healthcare coverage. So if you provide healthcare coverage to employees even though they weren't working and they weren't being paid, for example, that would qualify for qualified wages. Another layer to the employee retention credit, which makes, adds complication, is the way they define full-time employees. Now, what they use is they basically imported the Affordable Care Act full-time employee count to determine full-time employees. And by definition, that's essentially averaging 30 hours of service per week. And under the ACA rules, to figure out full-time, there's the look-back method, look-back measurement method, and the monthly measurement method. And so using one of those two sanctioned methods, with the look-back measurement method being more complicated, and that methodology will tell you how many full-time employees you have. You can't just use your sort of more commonplace understanding of 40 hours per week. You have to use this 30 hours per week. So in some respects, what that does is, that will trigger whether, your full-time count, and that's going to be important. And then to add additional layer is that when you're looking at these employee size thresholds, you're looking at it from the employer standpoint, and there's certain aggregated rules. So if you are aggregated under IRC 52A, B, 414, M, and O, those are the rules that say, well, all of those entities that are aggregated together as one employer, that's what you're counting. So, in the simplest example, if you're a company, if you are an individual and you own two different entities, but you're the sole owner, you're going to have to look at the two different entities and look at the combined workforce. You can't look at them individually. Okay, next slide. So here's some simple examples that even with a small number of employees, if you are subject to a COVID order or you had a decline in profits, and I'll get into that, the employee retention credit can still result in a very meaningful amount. So, for an employer with 5 employees with a significant decline in gross receipts for 2020 and just Q1 2021, you're looking at a 60,000 credit. If you go even, a little bit larger with employers with 20 employees subject to a COVID suspension order for 2020 and Q1 2021, you're looking at nearly $250,000. And we're looking at small size employers. Obviously, when we get larger, those amounts can be drastically bigger. Okay, next slide. So here's some examples. As I had mentioned earlier, next slide. I think you skipped one. If you can go back. Yes. No, I'm sorry. One more. One more. Okay, that's fine. One of the things you can see is if you have a company, let's say you have 110 employees with 65 full-time employees, you could get potentially a $3.6 million in total potential benefit. And so because you're looking at employee retention credit with 33,000 as per employee, that number can quickly escalate. And so this is something that if you are eligible, you really need to take advantage of it. So as I'd mentioned earlier, when we were looking at, the sort of simple examples, there's sort of two, what I'll call nature of impact tests, sort of how did coronavirus impact you? There's sort of two different ways. One of the ways is, either a full or partial suspension due to a COVID order, and the other one is what's called a significant decline in gross receipts. So let me talk about the suspension first. Now, you could have a full suspension, but you could also have a partial suspension. So this slide kind of gives you some overview of sort of what we mean by partial suspension. A full suspension, in the most simplest example, would be a situation where there is, for example, in Los Angeles, in Los Angeles County, there was an order that basically said all non-essential businesses need to be shut down, and you fall under a non-essential business. That is a fairly simple example of being subject to a suspension under a COVID order. When you are talking about, you heard on the, say the governor of your state made an announcement that his view is that non-essential businesses need to be closed. That's not enough. Like, you need something like of an order, whether it's from the city, the county, or state. So that's sort of the classic case of a suspension. But there are also some orders we've seen. They'll be very specific to a particular business, saying, nail salons need to be shut down. So you would fall. That's sort of another sort of simple case. There's theaters, certain restaurants, and I'll get into the restaurants because that may fall under the partial suspension. So partial suspension, according to the IRS, it's based on the facts and circumstances. The more clear-cut examples would be a reduction in operating hours. If the COVID order that applies to you specifically says you need to reduce your operating hours, or hours need to be closed certain hours, for example, that would be a partial suspension. There's also, and this comes into play typically in the essential, non-essential, or in the sort of fact pattern of like a restaurant with the takeout business versus the indoor dining business. That those kind of where there's sort of two operations of a business where part of it is shut down. So when you're looking at that, the test that you would apply is that at least 10% of the business, that's what would be considered more than a nominal portion. If 10% of the operations have, at least 10% of the operations have closed, then you would fall under a partial suspension. And there's two ways of determining that. The 10% can either be based on gross receipts or based on hours of service. A more complicated fact pattern is where you have a modification of your business that has a more than a nominal effect. And again, that needs to be at least 10%. The kind of examples that the IRS has provided are like occupancy restrictions, such as like, physical space changes for social distancing, appointment basis only. What the IRS has made clear is that altering customer behavior in and of itself is not sufficient. So the examples they provide is the fact that you require customers to wear masks or employees to wear masks, that's not enough. Making aisles, like at a retail establishment, going one way, not enough. You need to show that the modification has had more than a nominal effect, and the kind of things that you can look into are, the inability to continue comparable operations, and this is particularly significant for office type operations, remote work capability, the portability of the employee work, whether or not the in-person presence is there, and the amount of time and effort for transitioning from in-person to teleworking operations. So an example might be you have an operation where there's certain equipment that's only in the warehouse, for example, and you can't really port that. And as a result of that, you've basically, maybe your business wasn't shut down per se, but because of the in-person presence requirement to operate it, you've effectively been shut down. So those are the kind of things that you would look at. And again, it's really a facts and circumstances scenario that the IRS is going to be looking at. And so you want to, you're going to have to look at holistically. The sort of simpler examples that I'd mentioned earlier on, those are more clear cut. But if you fall into sort of the partial suspension, it's really going to have to be like, we got to look at the facts. Another area that the IRS had pointed out that is a more clearer case, if you will, of partial suspension is the inability to obtain critical goods or services from a supplier. So if you're an operation that's relying on some other supplier to provide you in order for you to operate, that's sort of a more obvious example. The other thing that the IRS has explained is it's not sufficient that you've had a loss of demand, because of the COVID order, folks are staying at home, so you've lost customers. And the way they've addressed that is really through the significant decline in gross receipts. And what you'll see is for the significant decline in gross receipts, you're looking at for 2020, the decline has to be greater than 50%, but for quarters in 2021, the decline must be greater than 20%. So it's a much lower threshold, and I think what the legislative body had recognized is that the 2020 employee retention credits having this decline of more than 50% was not enough to address all the businesses that were impacted by the coronavirus. And so they reduced that threshold. So the decline need only be greater than 20%. Okay, next slide. Okay, so as I mentioned, the rules are different for 2021. The way you calculate the employee retention credit is if you, it's 50% of the first $10,000 of qualified wages paid per employee in the aggregate for all quarters. So it's for all of 2020, 50% of the first 10,000. So translate that, 5,000 per employee receiving qualified wages. For 2021, an employer can receive 70% of the first 10,000 of qualified wages paid per employee in each quarter. So the maximum per quarter is 7,000, and the maximum for 2021 is 28,000. You combine the two, you're looking at 33,000. Okay, next slide. Okay, so what are the qualified wages? The qualified wages basically are dependent on the full-time count in 2019, as I'd mentioned before. And what you're looking at is, again, the 30 hours of service per week or 130 hours of service per month as defined by IRC section 4988, using either the IRS look-back measurement method or the monthly measurement method. And so if you see this chart here, so looking at 2020 eligibility, if you are less than 100, you're looking at qualified wages paid to all employees. And the same rule applies for 2021, qualified wages paid for all employees. Now, if you're into that middle category of 100 to 500, for 2020, it's only qualified wages paid to employees not performing services. And if you are looking at 2021, it's all wages. If you are in the 500 plus category, then for 2020, qualified wages are for employees not performing services due to COVID, and same with 2021. Okay, next slide. Okay, so here's some questions that we've seen from that have come from potential clients, and so I wanted to identify these because these are fairly significant. So the first question is, if I have more than 500 employees, can I still claim the employee retention credit? And the answer is yes. I think a lot of employers mistakenly believe they don't qualify because they have more than 500 employees. But as I mentioned, the eligibility criteria is based on full-time employees as measured under IRC section 4980H. And what the problem with a lot of vendors that are doing or proposing to do ERCs is they don't have the capacity to accurately perform the required full-time measurement counts, which is really unfortunate because that's has led to many employers not bothering to pursue it. But just because you have in a vacuum 500 employees, that doesn't mean you're not going to qualify with respect to wages. With respect to all wages, of course, even if you have more than 500 employees, 500 full-time employees, you will qualify for wages paid to employees that weren't working, but that obviously, is a tougher threshold. Another question is with regard to the Paycheck Protection Program or the PPP loans. For 2020, under the Coronavirus Act, the CARES Act, if you took out a PPP loan, you weren't eligible for the ERCs. However, what happened was when the Consolidated Appropriations Act passed back in December of 2020, it removed that bar, and so that you could do both the ERCs and the PPPs. But you want to do a careful analysis of the PPP and ERCs so that you basically, one, make sure that you're in compliance with both sets of rules, and the timing is going to be really important in terms of which wages are for the PPP loan and which wages you're going to use for the ERC refund claims or tax credit. So that way you maximize the financial benefits from both. Now, if you've already taken out the PP loan and you've already gotten forgiveness on it, that sort of fixes what wages you can't use. But if you haven't already gotten forgiveness, it doesn't matter that you've already gotten the loan. It's talking about the forgiveness element. So if you haven't done the forgiveness yet, you then want to basically figure out what the optimal scenario is so that you can maximize your loan forgiveness and maximize your ERCs. Now, the last question I had already kind of gone over is the full-time employee calculation. It's very important that you do it right, and if you do it under the ACA properly, you can minimize the apparent full-time count, which is going to be important. Okay, so next slide. So this is what I was getting into. We had an employer that was initially told by their CPA firm they didn't qualify for the employee retention credit because they had 1,400 employees. They were in the restaurant food industry with 35 locations in Southern California. But we accurately applied the IRS look-back measurement method, and it turned out they only had 370 ACA full-time employees during the requisite period, which was 2019, and then made them eligible for ERCs in 2021 for qualified wages for all employees, not just qualified wages based on wages paid for employees not working. The total benefit ended up being about $3 million because of the accurate and precise way that full-time employee counts were performed. Okay, next slide. So if you look at the logic tree here, this is basically the structure of it. And because the rules are so funky in terms of 2020 rules versus 2021, this is the overview. So first question, were any control group members fully or partially suspended due to COVID order? That's the first question. And the reason why that's significant is because the IRS has basically indicated that if you, for example, if you have different locations where some jurisdictions have applicable COVID order and other jurisdictions don't, you may be eligible for all of the jurisdictions, even though only some of the locations were subject to a COVID order. So that has some import there. So depending on sort of the next question, if none of the control group members were subject to any kind of partial or full suspension, the next question is the gross receipts test. Whether or not the control group's gross receipts for a quarter was less than 50% of that same quarter in 2019. Again, this is the 2020 logic tree. It's going to be different for 2021. So if you don't qualify under either of the sort of the nature of impact test, if you will, you're not going to be eligible for ERCs. However, if you had one of the members of your control group, or you as an employer were fully or partially suspended due to a COVID order, or you had gross receipts that were less than 50% from a quarter-to-quarter comparison from 2020 to 2019, then you will be eligible. And so now the next question is, are you under the 100 or the 100 full-time employee threshold? And depending on the answer, if you are under 100, then you are going to get potentially up to 50% of the qualified wages. If you are greater than 100, you're going to be eligible for 50% of the qualified wages, but the qualified wages are for wages of employees who did not provide services. Okay, next slide. So the logic tree for 2021, similar, except instead of requiring that your gross receipts had to be, with a 50% threshold. Now the threshold is 80%. So in other words, conversely, the decline was more than 20% as opposed to more than 50%. And now for the employer size, the number that you're looking at, the operative number, is 500 full-time employees, as opposed to 2020, where the sort of difference was 100 employees. And again, if you are above the 500 employee threshold, you're looking at 70% of qualified wages, all wages. And if you are above the 500 threshold, the employee retention credit is 70% of qualified wages for those employees who did not provide services. Okay, next slide. Okay, I wanted to talk about the interplay between ERC and Paycheck Protection, as well as other sort of what's called double dipping. The double dipping includes a number of other sort of tax credits, and the specific tax credits at issue will depend on the year. But as I mentioned, the same wages cannot be used for both to qualify for forgiveness as well as ERCs. And to the extent that PPP forgiveness allocated to wages is less than the total wages in the quarter, you can treat the remaining wages for the quarter as ERC eligible. So one of the things that the PPP, because a lot of employers that took out PPPs are will be eligible for ERCs. Now, with respect to PPP, one of the things that was one of the rules was that you could only take qualified wages up to 100,000. So the employee retention credit doesn't have that kind of cap. So even if you used PPP loan for a particular period, it only tags the first annualized $100,000 in wages for the employee. If you have employees making more than 100,000, the residual above 100,000 you can use for ERCs. That's assuming for a pay period. A period where you are both, you had forgiveness from a PPP loan, and you had, as well as ERC. So just because you took a PPP loan and was forgiven for a particular period doesn't mean that you don't have any qualified wages for ERCs. You can have it. Obviously, for the period you didn't have any PPP, then you would be, you could get potentially the ERC max. Now, there's also other double dipping, and depending on whether it's 2020 or 2021, they will consider, that will include WOTC credits, paycheck, paid family leave or sick leave. There's certain, restaurant revitalization grants, shuttered venue operators, a couple others. Basically, these are things that you would see on your IRS Form 941. That would that you would basically take out, because the theory being you can't double dip, you can't get like double credits for the same wages. Okay, next slide. So, as I mentioned, the PPP and ERC interplay is extremely important because so many employers that took out PPP are eligible for ERCs and previously didn't take it because of the 2020 bar where you couldn't do both. Now you can. So you want to do that. The two considerations: minimizing risk. You don't want to be in violation of basically double dipping. You also want to maximize benefit because the rules are, the rules for eligibility for PPP and ERCs are very different, but you can optimize it so they can work together. Okay, next slide. Oh, okay, so here's the list of the double dipping rule. Okay, so what we're looking at is FCRA. That is the Families First Coronavirus Relief Act. That was really the first coronavirus related federal legislation that came out, and it allowed for certain leaves, and if you sought to use those wages and get credit for that, you couldn't use that as a double dipping. There's the work opportunity tax credits, certain FMLA credits, research and development credits, Indian employment credits, employer wage credits for active military duty members, empowerment zone credits, and I had mentioned earlier, shuttered venue operator grants, restaurant revitalization grants, and certain SBA loans. Okay, next slide. So one of the things that is kind of important to note is that when the employee retention credit legislation came out, one of the things that the IRS did do is it extended the statute of limitations from 3 to 5 years. And so they can audit that for a lot longer period of time, and it really foreshadows the sort of, intent and likelihood of the IRS auditing the ERC. So it's important that you make sure that you do it properly and document it, and I'll talk to you about the documentation in a minute. And you really want somebody who's going to be able to properly analyze and document the employee retention credit to avoid double dipping, and otherwise to calculate it to avoid risk from audit. Okay, next slide. So what kind of documentation are you going to need? So here are the key ones. You want the qualifying reason. So are you based on a full or partial suspension? If so, you're going to want to, make sure you have a copy of the relevant COVID orders, the government COVID orders, and documentation to show why you qualify and the time frame of the suspension. One of the sort of nuances of the ERC is, so for the significant decline in gross profits basis, the period is going to be the quarter, because you're looking at a quarter-to-quarter comparison of the profits, and if you had that significant decline that quarter, you qualify. Now on the suspension, it's a little different in that you're not looking at it necessarily from a quarter to quarter. What you're looking at is the period of suspension and the qualified wages and the resulting ERCs for that period of suspension. So that's not necessarily going to be a quarter. So having that sort of documentation of the COVID order that applies, and then the documentation showing why you fall into that category and what time period is important. if you're doing it from a significant decline in gross receipts, obviously you're going to want to show your financials with respect to gross receipts for the particular quarter as compared to 2019 and to show why you qualify for that significant decline. Another important area is the employee count calculation. Because the ERC calculation varies depending on the FT count for the baseline year 2019, you're going to want to maintain the documentation of how you determined the number of full-time employees, and the number of full-time employees. So one, which qualified wages you qualify for whether it's 2020, 2021. And if you've already done that for the ACA, well, you're already ahead of the game because you've already got that done, because that is a big piece. Another is the calculation to support the amount of ERCs. The amount of ERCs is based on qualified wages. That includes wages, allocable qualified healthcare expenses, so you're looking at both from a pre-tax employee healthcare contribution as well as employer contribution. So, a typical example employer, the employee pays 50%, the employer pays 50%. Well, both pieces would be included. And you want to maintain the documentation for qualified wages. It's important of this sort of allocable qualified wages, because you're going to want to show that it is properly sort of attributable to each of the employees. Another area is for PPP borrowers, that's going to be really huge because forgiven payroll costs under the PPP loan program can't qualify for qualified wages. You want to make sure that you can show that the overlapping forgiven wages are excluded, and document that exclusion. And of course, the double dipping, if you're relying on other credits, you want to show that those were specifically excluded. Okay, next slide. So here I'm just going to briefly go over sort of how Trusaic can implement and guide you through the process. First step is assessing the IRS aggregated groups. These rules are different than the employer mandate and typical sort of ERISA type plans. You want to know who or what entities constitutes the employer, because that's really a threshold question, number one. Number two, making sure you got the accurate full-time employee counts under section 4980H of the IRC. Those two threshold questions really kind of triggers sort of, on the various logic trees, which way you go. So once that's determined, then you can determine which basis of eligibility you're going to fall under, the gross receipts test or the suspension test. You're also going to identify what the qualifying employees and the wages via payroll record review, looking at the data, document, basically gathering the data. There's going to be some client interviews, particularly with regard to the suspension, and then performing the ERC credit calculation on a quarterly basis. After you've done that, we then prepare the forms to claim the refunds for our IRS submission and maintain the documents in sort of audit ready fashion. And then step 4, a client receives the ERC employee retention credit from the IRS, which is typically in the way of a refund, and to the extent there's any kind of audit, we will provide assistance if needed. We stand by our work. So next slide. So the employee retention credit benefits using Trusaic is we minimize the risk of compliance issues and IRS audits. We ensure optimal ERC strategy balanced against PPP loans and avoid double dipping with other tax credits. At the end of the day, you're going to maximize your financial benefit to your organization while minimizing risk. Okay, so with that, if there are any questions, I can answer them. Also, Greg Casabucci, our VP of Partnerships, his contact information is there, and you can reach out to him for any questions that you might have raised beforehand and we forgot to, or any other follow-up. So with that, do we have any questions?
We do have
Hello?
one in the we do have one in the chat box,
Okay,
and I can read it for you.
okay, sorry, I don't see it in the chat box. Okay.
It's when you look at the greater than 20% of decline in gross recipients in 2021, what quarter are you comparing to? 2019?
Yes, you were looking at 2019. One of the kind of, I guess, for lack of a better word, oddities of the employee retention credit law is that everything is kind of functioning on 2019. That is the baseline year. 2020, obviously, everyone was impacted by COVID in one form or fashion. Employers, felt the brunt of the coronavirus impact starting roughly around March of 2020. And so the baseline year is 2019, where things were, quote unquote, normal, and you compare that to the baseline. That 2019 is going to be the baseline with respect to what the full-time counts are, which triggers, which qualified wages, what the qualified wages covers. It also is the baseline for the significant decline in gross receipts. So that's comparison. Well, how much of a decline in gross receipts did you have as compared to the baseline year? So that's 2019. One question that came up in the past that may be interesting to our audience. One question was asked about was foreign entities. Do they count? If you are part of an aggregated employer group, but some of your, I'll just loosely say affiliated entities are U.S., they don't count if they are not businesses subject to U.S. income tax. So that's kind of, generally speaking, foreign corporations are not going to be included. So that's kind of an interesting thing to note, because I think some employers are, worried about size when they start looking at it from a global standpoint. That's a question that came up. Any other questions?
There is another question. For double dipping scenario, we are a nonprofit organization. We received grant funding from donors that cover salary. Do we have to exclude them from the salary to be considered for PPR or ERC?
Yes, but not because so much from a double dipping standpoint. So when we were looking at gross receipts, if you are a for-profit entity, that is determined under IRC 448, and it's, whether it's on an accrual or cash basis, it's your gross receipts. For nonprofit, it is under IRC 6033, but that, so you're looking at, one, the way gross receipts is defined is different than for a for-profit company. And so under IRC 6033, it's like everything under the sink, basically, for a nonprofit company entity. When you're looking at the double dipping rules, you are looking at the different credits that are identified. If it is not one of those that are listed, then it should not count in terms of grants. Those would be sort of part of your gross profits, but it isn't a double dipping avoidance grant, if you will. Any other questions?
Thank you. There are a few more.
Okay.
Does PPP loan forgiveness count as revenue for the purpose of calculating the decline in revenue?
That is a good question, and I don't know the answer to that, so I'm going to have to follow up with you on that. If I get the person's email, I can follow up.
Okay, wonderful.
Okay.
I'll send that to you after.
Okay. So,
what employees qualify? Only retained from 2019?
The employees that qualify, for qualified wages, so it really kind of is based on the year. So when you're looking at it from how many full-time employees you have, you're looking at 2019. If you're looking at how much is my ERC, you look at the year of the qualified wages. So it's not about who's retained or who's not retained. It's if you're looking at, say, 2020 ERCs, you're looking at all of the qualified wages for 2020. It doesn't matter whether they were retained from 2019. So just, you got to look at the year of the qualified wages without regard to whether they're continuing employees or not.
Thank you. And this is a clarifying question. It might have been in regards to a previous question, but to clarify, if we do not qualify for the full or partially suspended for 2021, is the decline truly less than 80% gross receipts?
Yes. So, there's going to be employers that, potentially fall under both categories. It's not like you have to qualify under both. Either one is okay. Of course, both is okay too. For 2021, the threshold is 20%. So if you have more than a 20% decline, when you compare 2019 versus 2021, or the particular quarter, you're gonna qualify. For 2020, the comparison is 2019 to 2020, and the threshold number is now 50%.
Thank you, Joanna. And next question, to receive a refund for 2020, do we submit only IRS Form 7200 or also 941X too?
You are going to be submitting the Form 941X for sure. Unless you haven't, that's amendment purposes. If you haven't submitted it, the original, that's you don't need to do the amendment, obviously. But if you've already submitted the original form, you want to submit the amendment. That's Form 941-X.
Perfect. And for FTE count, can an employer go by the number reported on the 1094C form?
You should, because for 2019. So if you're looking at the 2019 Form 1094C, sorry, I'm getting all my numbers mixed up. Form 1094C for the year 2019, you can use a full-time count that's identified there. Of course, key is you want to make sure that number is right. If that number is wrong, you may end up, foreclosing yourself from, more ERCs. I mean, it has this sort of exponential, amount, like, going from, say, 5 employees to 90 employees, the amount of ERCs that's potentially available is huge. So getting the full-time count, especially when you're kind of hovering around the 100 full-time employee threshold, or the 500 full-time employee threshold, those two sort of thresholds are really important. And for 2021, that 500 employee threshold is going to be key. So, if you've just gone ahead and, kind of eyeballed the number of full-time employees, which you shouldn't have done anyway for the 1094C, but let's say you did that and you overestimated the number of full-time employees, you could potentially be foreclosing your ability to get, the ERCs for qualified wages for all employees. Remember, for 2021, the threshold, 500 employees, is, if you're under 500 or 500 or less, it's all qualified wages. If you're above the threshold, it is qualified wages, means wages paid to those employees that didn't work. So that's a big difference. So getting under the 500 threshold is going to be super important for you to be able to, get ERCs for all employees without restriction, if you will.
Excellent. Thank you, Joanna. And this question just came in. Are you comparing all 4 quarters or only 1 quarter?
Well, okay. That question has sort of pieces to it. In terms of what you're comparing, for significant decline in gross receipts, you're looking at it on a quarter-to-quarter comparison. from a full-time employee count, you're looking at what your full-time employee count was for 2019. When you're looking at for 2020, for significant decline, you are looking at it on a per quarter basis. So it depends on sort of what you're looking at. But from when you're looking at significant decline in gross receipts, you're doing a quarter to quarter comparison, but you can be eligible for the ERCs for all 4 quarters of 2021 and for 2020 for the year. And as I told you, there's a little bit of a oddity in that the 2020 ERCs start after March 12, 2020. And so even though you're eligible for ERCs for the year, the actual wages that are eligible for the ERCs begin on March 13. So there's, as I said, there's a lot of sort of very specific rules. Or just sort of ticky-tack rules that you need to know, but they're important because it's, you got to navigate through those rules in order to get the ERCs.
Perfect. Thank you, Joanna. And this question also, this just came in. So reading off the IRS website, to qualify for eligibility for 2021, it states that nonprofits may qualify with significant decline in gross receipts, in which gross receipts are more than 80% of its gross receipts. To clarify, is that 20% decrease or 80% decrease compared to 2019?
Oh, my apologies if that was unclear. The gross receipts, it's basically you need to show a decline of more than 20%. So it's basically if 2019, if you had gross receipts of, let's just say for simplicity, $100,000, what you're looking at is for 2021, you just have to show, say, that your gross receipts was 79,000, so more than 20%. I also just I wanted to clarify a point with regard to the 1094C question with regard to can you use the full-time count. One thing to note is if you don't have any affiliated entities that fall under the 1094C form, what's called the aggregated ALE group, if you are just one entity, you could use a 1094C with the caveat that it needs to be done right, and if you've overestimated that, you're kind of shooting yourself in the foot from the ERC standpoint if you're hovering around either the 100 or 500 full-time employee threshold. But if you're part of an aggregated group, you're going to have to look at the entire aggregated group for who is the so-called employer, and then figuring out the workforce, the full-time employee count for that. And one of the kind of rub is that the rules for determining which groups get aggregated together for ACA purposes are different than the aggregated rules for ERCs. There's a lot of similarities, but there's also differences. One of the differences is sort of, without trying to get in too picky in the details, but for control groups, for trades or businesses under common control or control groups of corporations, the threshold for controlling interest is 80% for ACA purposes, but they're only 50% for ERC rules. The long and short of it is that you could be aggregated for ERC purposes, even though you weren't aggregated for ACA rules. And so there's a little bit of danger in relying on the 1094C if you are part of an aggregated group, and also, making sure that number is right.
Thank you, Joanna. That's it for questions.
Okay. Well, you see Greg Casabucci's contact information if you have any other questions. And, we thank you for your time, and back to you.
Yeah, I just want to say thank you again, Joanna, for presenting. I also wanted to let everyone know we will be sending out a recording of the presentation as well, so please just keep an eye out for that. Other than that, thank you all again for joining, and I hope you guys have a great rest of your day.
Thank you.